On the 2nd of December 2001, the seventh largest company in America filed for bankruptcy. That wasn't the remarkable part. The remarkable part was that 3 weeks earlier, they had reported $100 billion in annual revenue. 3 weeks. The auditors had signed off. The banks had lent money. Wall Street analysts had price targets of $90 a share, and every single one of them had missed, or more precisely, had chosen to miss, one of the greatest accounting frauds in corporate history. This is the story of how $70 billion in shareholder value disappeared, of how 20,000 employees lost their pensions, and of the single accounting rule that made all of it perfectly legal until the day it wasn't. My name isn't important. What's important is what's in these documents. Enron started as a pipeline company. In 1985, two gas companies merged, Houston Natural Gas and Internorth, and the result was Enron Corporation, headquartered in Houston, Texas. For the first 5 years, it was boring. Gas moved through pipes. Revenue came in. Costs went out. The books balanced. Then, in 1990, Jeff Skilling arrived. Skilling had spent years at McKinsey and had one idea that would transform the company. Enron shouldn't just move gas. It should trade gas. It sounds obvious now, but in 1990, energy commodities weren't traded the way stocks were. Skilling convinced Enron's board to create an energy trading desk, essentially an over-the-counter futures market for natural gas. And then he convinced them to adopt a new accounting method to book the profits from those trades. Here's where it starts getting strange. Mark-to-market accounting was, and still is, a legitimate method used by banks and financial institutions. The idea is simple. If you hold an asset, you record its current market value, not what you paid for it. A bond portfolio worth $10 million today goes on the books as $10 million today. Skilling's insight, or rather, his stroke of genius, was to apply this same logic to long-term energy contracts. Enron would sign a 20-year deal to supply natural gas to a power plant. Under standard accounting, Enron would book revenue as the gas was actually delivered, year by year, as the cash arrived. Under mark-to-market accounting, Enron could book the estimated net present value of that entire 20-year contract on the day it was signed. Day 1, before a single cubic foot of gas had moved through a single pipe. The SEC approved this method for Enron in 1992. At the time, it seemed reasonable. Enron had real contracts, real counterparties, real obligations. But there was one small problem. How do you value a contract for which no market exists? Nobody was trading 20-year natural gas futures in 1992. There was no public market price to look up. So Enron had to estimate the value of every contract itself. And who made those estimates? Enron made the estimates. The company that booked the profit also decided how large that profit would be. And the incentive structure, executive bonuses tied directly to reported earnings, created an obvious and catastrophic conflict of interest. By the mid-1990s, Enron had created an entire department whose job was to model the future value of its contracts. The more optimistic the model, the higher the reported earnings. The higher the earnings, the higher the stock price. The higher the stock price, the richer the executives became. In 1996, Fortune named Enron America's most innovative company. The first of 6 consecutive years it would hold that title. In 1999, Enron launched Enron Online, the world's first major online energy trading platform. Within a year, it was processing $2.5 billion in transactions per day. The stock hit $90 a share in August 2000. And then the problem arrived, not from outside, from inside. What I'm about to show you is the part that nobody teaches in business school. The original mark-to-market scheme worked reasonably well when Enron was trading gas and electricity, markets with at least some comparable transactions. But by 2000, Enron had expanded into broadband, water utilities, and weather derivatives. These were markets with essentially no price discovery, no comparable transactions, no public market values. But Enron was still booking the estimated future profits of these contracts on day one. In 2000, Enron signed a 20-year broadband contract with Blockbuster Video to deliver movies on demand. Blockbuster had roughly zero technical capacity to execute this. The deal fell apart within months. Enron had already booked $110 million in profit from the contract, $110 million in profit from a contract that produced zero revenue. That never delivered a single movie. This is the machinery of the fraud. But the machinery needed a hiding place. Enter Andrew Fastow, Enron's CFO, and his network of special-purpose entities. An SPE is a legal entity created for a specific financial purpose, a shell company. They're legitimate tools used by banks and corporations around the world for risk management. But Fastow created hundreds of them, with names like LJM Cayman, Jedi, and Chewco, specifically designed to move Enron's mounting losses and debt off its balance sheet. Here's how it worked. Enron would transfer a losing investment into an SPE. The SPE absorbed the loss. Enron reported clean earnings. The SPE was funded by Enron's own stock. The entire system was self-referential. It only worked if Enron's stock price never fell. And for years, because the stock kept rising, nobody looked closely enough to notice. And this is where the real story begins. In August 2001, a woman named Sherron Watkins sent a memo to Enron's CEO, Kenneth Lay. The memo began, "I am incredibly nervous that we will implode in a wave of accounting scandals." She laid out exactly how the SPEs worked. She explained the self-referential dependency on the stock price. She said it could all collapse the moment the stock fell. Kenneth Lay forwarded the memo to Enron's lawyers and to the auditors at Arthur Andersen. Arthur Andersen had been Enron's auditor for 16 years. In 2000 alone, Enron paid them $52 million, $27 million of that for consulting work, not auditing. The response to Watkins's memo was a legal review. Did Enron have any obligation to restate its earnings? The conclusion? No legal obligation. The structure was technically compliant with accounting rules. Just barely compliant was enough. 2 months later, Enron restated its earnings anyway. On October 16, 2001, Enron announced a $618 million quarterly charge and disclosed $1.2 billion in shareholder equity write-offs that had never appeared in its published accounts. The stock fell from $32 to $20 in a single session. Investors finally started reading the footnotes of Enron's annual reports, footnotes that had been there in public for years, describing the SPE structures in opaque but technically accurate language. No one had looked, but that was only the beginning of the collapse. On November 28th, Moody's and S&P downgraded Enron's debt to junk status. This triggered something nobody had adequately planned for. Many of Fastow's SPE debt structures contained covenants tied to Enron's credit rating. The moment the rating hit junk, those covenants triggered, demanding immediate repayment of billions. Enron owed $690 million due immediately. It had approximately $1 billion in cash. Most of that cash was already earmarked. Dynegy, a rival energy company, had agreed to acquire Enron for $9 billion just weeks earlier. After the junk downgrade, Dynegy walked away. On December 2001, Enron filed for Chapter 11 bankruptcy, at the time, the largest corporate bankruptcy in U.S. history. $60 billion in direct shareholder value gone. 20,000 employees lost their jobs. Many had their retirement savings held in Enron stock they had been explicitly encouraged to hold even as executives quietly sold. Ken Lay sold approximately $300 million in Enron stock in the period leading up to the collapse. Jeff Skilling had sold $66 million in stock and had resigned as CEO in August 2001, 4 months before the bankruptcy. Here's what you're actually looking at. The accounting rule that made all of this possible was approved by the SEC. It was used by Enron with SEC awareness. It was audited, or at least nominally reviewed, by one of the largest accounting firms in the world. The problem wasn't that the rules were broken. The problem was that the rules worked exactly as designed, and the incentive structures those rules created turned a legitimate accounting method into a machine for institutional fraud. Arthur Andersen was convicted of obstruction of justice for shredding Enron-related documents. The conviction was later overturned by the Supreme Court. But by then, the firm had already collapsed. 85,000 employees gone. Jeff Skilling was sentenced to 24 years in prison. He served 12 and was released in 2019. Ken Lay was convicted on 6 counts of fraud and conspiracy. He died of a heart attack before sentencing. His conviction was vacated. Andrew Fastow received a 10-year sentence and served 6. The Sarbanes-Oxley Act, the most significant change to corporate financial governance since the 1930s, was passed in 2002 directly because of Enron. It required CEOs to personally certify the accuracy of their financial statements. It created new criminal penalties for securities fraud. It is the most lasting legacy of Enron's collapse. A set of rules specifically designed to prevent a company from doing exactly what Enron had already done. And this is the part that should stay with you. Every person who should have caught this, the auditors, the analysts, the banks, the regulators, had a financial incentive to look the other way. Arthur Andersen needed the fees. The banks needed the deal flow. The analysts needed access to management. The regulators had limited resources and a culture of deference to major corporations. None of them was stupid. All of them missed it, or chose not to see it. The single most important question in any financial scandal is never, how did this happen? That's always the same answer. Incentives. The real question is, who was watching, and what were they being paid to watch for? If you want to understand the 2008 financial crisis, the next time the same incentive structure produced a similar result at 10 times the scale. I've already made that video. Link in the description.